Hello, everyone. Welcome back to another episode of The Week in Charts. Charlie Bilello here, bringing you once again the most important charts and themes that I'm seeing today in markets and investing. If you're watching this on YouTube, take a quick moment, hit that subscribe button for all the latest content from us. A lot on the docket today. Stick around to the end. Easy money is back, ignoring inflation. Jobs market is at an inflection point, easing into a mania. Spending like there's no tomorrow, and we'll end as we always do with something positive: higher real wages and more affordable rents. So here we go. After a brief hiatus, easy money is back. What am I talking about? Federal Reserve is set to cut interest rates once again, resume the rate cutting next week at the September meeting. So similar to last September, the Fed on hold all year long and doing their first rate cut of the year in September. Last year, they ended up cutting 100 basis points, so 1% in the last few meetings of the year. This year, markets expecting 75 basis points in the next few meetings, 25 basis points next week. So here are the odds: 95% probability of a 25 basis point rate cut, so pretty much a done deal. We're going to see a rate cut. Just the question is, slight question, is it going to be 25 or 50? And if the odds stay the way they are right now, 95% chance of 25 basis point, 5% chance of 50 basis point, I think the Fed's going to just do the 25 basis point. And I think that because in every single meeting since the beginning of 2009, the Fed has done exactly what the market was pricing in heading into the meeting. So we'll check these odds before the meeting next week, and if they stay the same, we're likely to see that 25 basis point cut. But really, the focus is going to be on what the Fed does in terms of its projections. So at the September meeting, they do this every other meeting. They update their projections in terms of where do they see the Fed funds rate going in the next year, and what do they see for unemployment, what do they see for inflation, what do they see for GDP growth. So the market's going to be looking at pretty closely what are the changes between this projection and the projection before. And all year long, the Fed was projecting 2 rate cuts for 2025. And so really the focus is going to be, are they going to shift that to 3 cuts? Because that's what the market is now pricing in. And what are they going to be talking about for 2026? The market's saying 3 more rate cuts for 2026. Is the Fed going to be more dovish in that expectation, less dovish, more restrictive? We'll see. Powell's going to comment as well. Obviously, there's going to be a press conference. So we'll see what happens. But the market is pricing in, at least right now, a done deal rate cut next week, and really an easing cycle to continue throughout 2026, bringing that Fed funds rate down below 3%. So what happens when the Fed cuts interest rates? What's going to be the impact in terms of the stock market? There, of course, no one knows. I'll talk a little bit later. Obviously, the markets have been running up in anticipation of this. Super excited about easy money policy across the board. All asset classes really running higher. But in terms of the bond market, the biggest impact, of course, is going to be on short-term interest rates. And there, it's highly predictive because the Federal Reserve controls those short-term interest rates. So if you're in things like a savings account or a money market fund, you're going to see those yields come down, and come down very quickly when the Fed cuts interest rates next week. And the more they cut interest rates, the lower the yield is going to be on cash-like instruments. But in terms of longer-term interest rates, it's not as easy to predict where they're going to go. If we look at something like the 10-year Treasury yield, or we look at 30-year mortgage rates, well, really that's going to be dependent on different factors, really market participants' expectations for growth, for inflation, and longer-term projections for those things. That's going to dictate where these rates go. And as we saw a year ago, people were expecting mortgage rates to come down when the Fed cut interest rates last September. That's not what happened. They ended up rising about 1%, and they've since come back down. But the reason for that is these longer-term Treasury yields, like the 10-year Treasury rate, rose after the Fed cut interest rates. And the reason that happened was inflation expectations went higher. You had, of course, the government still running these deficits. So all of these different factors driving up long-term interest rates. Now, they've come back down. We have a 10% 10-year, 4% 10-year Treasury rate right now. But the question is, if the Fed cuts next week, as they're expected to do, and then they keep cutting interest rates, does that necessarily mean the 10-year is going to come down? Not necessarily. If markets think that the cutting of interest rates is going to lead to higher inflation, you could actually see these longer term treasury yields go up, and in which case it would be very hard to see mortgage rates come down very much from there. So remains to be seen what happens on the long end. That's going to be, I think, a big focus for market participants, for investors. Obviously, housing market being impacted a lot by the increase in the mortgage rates over the past few years, but it seems very unlikely for this mortgage rate to go back down to where it was a few years ago. And the reason for that is you had a whole confluence of things that brought that 30-year mortgage rate down to record lows at 2.65%. You had the Fed funds rate at zero, of course. You also had the Federal Reserve engaging in massive amounts of quantitative easing, driving things like the 10-year Treasury yield all the way down well below 1%. And they were buying massive amounts, trillions in mortgage bonds, driving mortgage yields lower directly. So for all those reasons, unlikely to see a sub 3% mortgage rate again, unless the Fed starts engaging in all of those policies once again. Now, could you see the mortgage rate go below 6%? Absolutely. But that's going to be dependent, as I said, on where these longer term treasury yields go from here. Let's talk about what the signal the Fed will be sending when they cut interest rates next week. I think it's going to be a twofold signal in terms of their belief about the economy, which I think it's going to be signaling their weakness in terms of their expectations. But more importantly, in my view, there's going to be signaling that they really are going to be ignoring inflation and cutting interest rates. And I say that because we got this hot CPI print this week, 2.9%, showing the highest inflation since January in the U.S.'s overall inflation, and the core rate of inflation, which excludes food and energy, 3.1%. That was the highest since February. So inflation moving away from their target, and the Fed's essentially going to say, no, it's transitory. We're going to ignore that part of it. We're going to focus on the other part of our mandate in cutting interest rates next week. And they have a lot to talk about in terms of the jobs market, and I'm going to talk about that in a bit. But really, by cutting interest rates with markets at all-time highs, with credit spreads near record tights, the Fed is essentially saying, we don't care about this inflation target that we have, that 2% inflation target, throw it out the window for now. And if we look at what the Cleveland Fed is projecting for inflation here, September, they're not saying it's going to come back down. They're actually saying it's going to go up to 3%. And the core PCE, which is the Fed's preferred measure of inflation, they're saying is going to move up to 3% as well. So at least at the next meeting, if the Fed does indeed cut in September, they're going to have to deal with this higher inflation print once again in October, and they're going to have to essentially say, we're ignoring inflation because we're that worried about the U.S. economy. We're that worried about the jobs market. And in terms of that 2% target, I think any way you look at it, there's no way the Fed can say they're adhering to it, because inflation has averaged double that 2% target since the beginning of 2020. And of course, you remember that's when the Fed did this massive inflationary policy of printing 40% increase in the money supply, cutting rates to 0%, doing massive quantitative easing. Well, we've seen the results of that, 4% annualized inflation since the beginning of 2020, double the Fed's target. And you can see the cumulative price increases over the last 5 years really tell the story here. 20, 30, 40, 50% increases in the major categories over the last year. Yes, inflation has been much tamer than these increases would indicate, but you have to look at the cumulative rate of inflation. You can't just look at the last year. That's what I've argued. And this is why I believe the Fed shouldn't be in control of determining interest rates. The free market should determine it. And maybe if the free market was determining it, you would have a lower interest rate at this point, and maybe it will be higher. We just simply don't know. I just think it's too much to entrust 10 people sitting in a room expecting them to get it right every single time. They've shown they've gotten it wrong time and time again in terms of figuring out what's the important interest rate for the entire $30 trillion economy. They're supposed to determine that. That would be better than the free market. I think that's a communist principle, to entrust a small group of people instead of a free market. We don't have the Fed telling car companies how many cars to manufacture. We don't have the Fed telling supermarkets, this is how many bananas you should hold, and this is how many bananas you should sell this week and next week. And we certainly shouldn't have the Fed be saying this is what the interest rate should be. We should have the free market saying this is what the cost of money should be. But as of now, not enough people pushing for anything like that. The Fed continues to increase in terms of their powers, and they have this dual mandate. So as long as they have the dual mandate, they're going to be able to say, well, we're shifting here. We're focusing more on the labor market versus inflation. Yeah, we haven't achieved our 2% target, but the labor market's weakening. We can't ignore that. So we're going to go back to easy money policy because it's the easy policy. It's the same reason why politicians always always err on the side of running deficits and spending money because they're not going to take the pain. Then the next politician will take the pain. So same thing, the next Fed chairman, the next Fed governor is going to take the pain. They'll ease now, and then at least people won't be pointing fingers in the future. If the jobs market continues and say, well, why don't you cut interest rates? They can point to this and say, we saw the job market weakening and we cut interest rates. But was that actually the right thing to do? We don't know because it's not a free market. They're essentially saying that they know where that interest rate should be. And I just think in this day and age where we have all this data and information and we have free markets in many other areas that have worked to lift prosperity for everyone, why do we keep this antiquated system of believing these 10 people know better than the markets in terms of setting this interest rate? But these 10 people for now are going to determine it, and what they're going to point to is a labor market that's at an inflection point. So all of the data is showing the labor market is cooling. Really, the question is, do you think we're going to start to see outright layoffs, or is it just a gradual weakening in the labor market? And what we've seen in terms of revisions in the past few weeks has just been absolutely massive. Of course, the August employment report, we saw downward revisions, and what that showed essentially was an end to this job streak of positive payroll growth in the U.S. So that ended in June here with this negative 13,000 number. It was the first down number in terms of jobs for any month. You have to go back to 2020, and that ended the second longest streak in history, actually, of positive jobs growth at 53 consecutive months. And this, I think, is something the Fed's going to be talking about next week, is the fact that the labor market now is in equilibrium. So we were at this state a few years ago in 2022 where we had record number of job openings in the U.S., over 12 million, much higher than the number of unemployed people. So you had a very, very tight labor market, tightest really in history. But now that has shifted. We're now in equilibrium. We're now actually at the point where the number of unemployed people in the U.S. is higher than the number of job openings. That's the first time we've seen that in a few years. And I think they're going to be talking about this gradual increase in the unemployment rate to 4.3%, still well below the historical average of 5.7%, but trending upward, obviously. And if we look at youth unemployment, this is something I talked about in a recent podcast with Peter Maluk, 9.4%. So a big disparity here. Younger workers are having a harder time finding jobs coming out of school. And really what that's telling you is companies are becoming slower to hire in terms of their new class to add to payroll. So they're not yet doing these massive reductions, mass layoffs. We aren't seeing that across the board, but what they are doing is being very careful. If someone leaves the company, they don't seem to be hiring a new person to replace them as quickly. And for the new classes coming in, they're seeing slower rates of jobs growth. So it's becoming harder to get that first job. So someone without experience, it seems like it's gradually becoming harder and harder to get that job, whether that's due to AI or due to a softening in the economy. It'll be interesting to see what the Fed says about that, but all signs point to a cooling in the labor market. And the big question is, in terms of the labor market, is can you trust any of this data? Because you get so many massive revisions. We actually saw the biggest downward revision in history just this week in terms of revising payrolls for the year ending March 2025. They said it was actually 911,000 lower than what they had stated. And if you look at the revision the year before that, 818,000, on the downside. The year before that, 306,000. And this is nothing new. It's just the numbers have gotten bigger in terms of there's always been these crazy revisions in both directions. And usually when you're going into a recession, the revisions are on the downside because obviously they're doing a lot of estimates in terms of what the jobs number is. And when you have a recession, they're just behind the curve. So you can see here in 2009 and 2010, these downward revisions. And then coming out of the recession, you tend to see revisions in the other direction. We saw that coming out of 2020 as well. But the last few years, and this is kind of an outlier in terms of history, we're seeing these big downward revisions, but we're not yet in an economic recession in a traditional sense. So the question is, well, what's going on here? Is the data becoming less reliable? If we don't even look at the BLS data and we look at something like ADP, which I would say is more reliable because they're actually looking at companies that are signed up to their services. Well, they're seeing similar job slowdown. I would say not as dramatic in terms of all these revisions, but definitely a cooling. So kind of confirming that there definitely is weakness in the jobs market. The question is how much. And as I always say, look at the actual real-time data in terms of jobless claims. This will tell you the story. When there's actual layoffs going on, you're going to see it in people filing for unemployment claims. And we were talking about that for much of the first half of the year, this rise in jobless claims. We said it was kind of getting to the point where it would be worrisome. And then it just did a reversal on the downside. But in the last few weeks, we're seeing it move up sharply again. And when we get to that recessionary period of time, what you tend to see is this rise and not come back down. So if we were to see this past the high from a few months ago and continue higher, I think that would be a sign. And the question you often get is this going to give us a warning 6 months in terms of 6 months before a recession? Definitely not. If we go back to 2007, because you kind of have to throw out 2020 just because of the situation there. If we go back to September 2007, we look at jobless claims, you would have thought that things were okay. And, yeah, it was rising a little bit from the previous few months, but nothing seemingly alarming. And then, of course, a few months later, the worst recession since the Great Depression had started. So watching this closely, if we look from here in 2007 to the end of 2007, what you saw is jobless claims trending up and starting to trend up more rapidly. So we'll watch for that this year as well. And in terms of the market's reaction, in terms of the stock market, very similar to '07. So I would say credit spreads were still very tight then. The S&P was still hitting new all-time highs. It didn't peak until October 2007. So yeah, these things are leading indicators, but it doesn't have to happen months and months, and certainly not years in advance. These are more closer to the beginning of recessions where you tend to see these indicators rise. But is it different this time in terms of the labor market? Are we seeing this weakness because of AI and because of these other factors that don't indicate a general recession? That's going to be the big question for the market. As of now, that's what the market seems to be pricing in. This is just AI related. This is an adjustment. This is a big disruption, but it's not an indication that the overall economy is going into a recession, which is why it's still a strange situation to see the Federal Reserve easing into what's essentially becoming a mania in terms of stock prices going up, crypto going up, gold going up, all different asset classes appreciating, and the Fed is saying we need to ease monetary policy. That you really haven't seen before, I would say, in history. You got to go back to maybe the 90s there. But in 1998, when the Fed did this, the market was in a 20% drawdown. There was a crisis going on in terms of long-term capital, and the Fed eased. And then you had 1999, and then the Fed started hiking interest rates pretty aggressively in 1999 into the 2000 peak. Here, they're cutting interest rates as inflation's going up, and as stock market continues to hit record highs. Very unusual situation here. The S&P 500 hit another milestone this week, crossing above 6,600 for the first time. That was the sixth 100-point milestone of the year for the S&P 500. If we look at the Dow, another milestone there, 46,000 for the first time. And as I talked about on a recent show, the Dow hit another all-time high. Now it's a record number of years in terms of consecutive years with the Dow hitting at least one all-time high. The NASDAQ composite hit 22,000 for the first time. So all of these major indices hitting record highs together. The S&P 500, 24 all-time highs this year now. That follows 57 in 2024, which is the fifth most of any year in history. And prices are going up faster than earnings. This is what I keep talking about. What's the biggest risk in the market? Well, it's that investors get overly optimistic about the future because things are going on, earnings are going up, everything seems to be good. The Fed's cutting interest rates, and perhaps they're projecting too much of that into the future, saying that all of that good stuff is going to continue. And we could just see that in the valuation ratios here. S&P is now trading at 27 times price to peak earnings. And you have to go back to 2000 to see a ratio higher. Really, that was the only time period we've ever seen it higher than today. And if we look at the price to sales ratio, continues to go up around 3.3 now, highest level ever, so above even the 2000 dot-com bubble peak. So the Fed is very much easing into a mania. Gold, the best performing asset class so far this year, but you can see international stocks having a banner year, outperforming almost double the return from U.S. stocks. Crypto, of course, doing well. Emerging markets, convertible bonds. The U.S. stock market, looking at the S&P 500, up 13% here. Everything participating. So investment grade credit spreads, tightest since 1998. High yield credit spreads, near record tights. You're seeing the overall U.S. bond market, because that 10-year yield is down to 4%. It's actually up 6.5% now on the year. Very strong year. And cash is the worst performing asset class on the year, and it's up 2.9%. So rising tide lifting all boats. It would be the first year, if the year ended like this, first year since 2019 that every major asset class was higher. 2019 being, of course, another year where the Fed was cutting interest rates, easing monetary policy. So that would be a similar situation to today. The difference, of course, is that valuations today much, much higher than back then. And the big story this week was one of the big tech companies from the 90s is back with a huge gain, 36% in a single trading day this week. That was the biggest rise we saw since the mid-1990s, third biggest gain in history for Oracle, huge increase in its market cap. This is not a small company, so huge, huge increase. Why did it go up so much? Well, really their guidance for their cloud infrastructure, AI infrastructure, going up exponentially. At least that's their projection. They're saying that it's going to jump from 77% to 18 billion in the last year, and from there it's actually going to go up to 32 billion, then 73 billion, 114 billion, and 144 billion. Just incredible growth in the years to come. So this is what they're saying is going to happen. What's actually going to happen, we don't know, but they're saying a lot of that revenue has already been booked. So they're saying the performance obligations, so contracted revenue, these are contracts that have been signed already. That's at 455 billion. It's up 359% from a year earlier. So certainly the expectation is they're going to see tremendous revenue growth, tremendous earnings growth going forward. They talked about signing 4 multi-billion-dollar contracts with big players in the space, OpenAI doing a big deal with Oracle. So this AI infrastructure spending is spreading here. Obviously, NVIDIA has been the biggest beneficiary to date, but a company like Oracle, it didn't seem like investors were appreciating that these numbers were possible, and just stunning, stunning projections. Now, if there's a slowdown or there's overspending, can these companies cancel these contracts? I don't know what the details are about all of this stuff, but the market seems to be betting, at least based on the stock price reaction on that single day, that the growth is going to be much higher than they were anticipating earlier. So if you're thinking about markets, investing the rest of the year, now's a perfect time to reach out to us at Creative Planning, creativeplanning.com/Charlie. Schedule a call or a meeting with an advisor and get a free wealth path analysis. We'll go through your portfolio, go through your financial plan, make sure you're on the right path to financial independence. At Creative Planning, we're in all 50 states, so we likely have a location right near you. Over 370 billion in assets under management and advisement, and we're here to help. So reach out to us today, creativeplanning.com/Charlie. So I want to talk about spending like there's no tomorrow. Of course, that would be the federal government. They haven't got their fiscal house in order. We got the latest monthly Treasury statement. What did it show? Continued deficit, 1.9 trillion over the past year. How do we get there? Very simple. Unlike households in America who try to balance a budget, try to save money, the federal government does the opposite. They spend way more than they're taking in revenue. 7.1 trillion in spending over the past year, 5.2 trillion in revenue, and that gap, that deficit is just compounding, driving the national debt higher and higher. And if we look at the interest expense on that debt, it's going higher as well because interest costs have gone up over the past few years. And of course, that national debt balance has gone up a lot as well. So record high in terms of this interest expense, 1.2 trillion over the past year. We've never seen it that high before. It's more than doubled over the past few years. Incredible increase. And if we're looking at the US national debt here, it was the ceiling was raised by 5 trillion under the Big Beautiful Bill Act, and we're already $1.2 trillion into it. So July 3rd, the ceiling is lifted, and now 2 months later, we're at 37.4 trillion, 1.2 trillion higher. I suspect in the next month or so, we're going to see 38 trillion in terms of this national debt. And at some point in 2026, unless something drastic changes, we're going to see 40 trillion. And the real troubling thing is that we're still, as of now, in an economic expansion. And the question is, what is going to happen to this deficit if we do see a downturn in the economy? We're going to see this revenue number go down, of course, and there's going to be a lot of calls to stimulate the economy and increase this spending number. So it doesn't seem likely, if and when we have that economic weakness, that people are going to talk about trying to balance the budget then. So we're just going to likely see even bigger deficits. And what asset class likes that type of uncertainty? It's really obviously not a good thing long term. Well, that would be gold. Gold's up 38% this year, on pace for its best year since 1979. And gold and the S&P 500, if I asked you in the last 20 years, well, which asset class has done better or worse, you probably get different answers. It's pretty remarkable, actually, that over the last 20 years, the S&P 500 ETF and the gold ETF have about the same return, about 660%, both of them. And very different paths, right? You had gold doing very well out of the gate. So 20 years ago, we're talking about 2005, and gold had a great run, of course, into the financial crisis, doing well after that as well, while stocks, of course, took a big hit. But after that, stocks would recover. The two would meet here in about 2017. And since then, and really since 2020, both asset classes are up significantly. So both asset classes benefiting from the huge increase in the money supply, the massive amounts of inflation. Investors have really flocked to these asset classes, real assets, in terms of trying to protect themselves against higher prices. Just fascinating to see, and really interesting the past few months here, seeing gold hit record highs and the S&P 500 hit record highs together. I think a lot of people, when they think about gold, they think it only performs well during periods of crisis, and it always moves opposite the S&P 500. Historically, that's not necessarily the case. Gold has about a zero correlation to the stock market, which means that sometimes it's moving in the opposite direction, but it could also be moving in the same direction. Just overall, on average, it has no correlation. And so interesting that in 2022, the both of these assets actually went down together. And then, since the low really in 2022, both of them hitting new highs here. And the past few months, again, just really interesting to see. Even though that tariff uncertainty was lifted, gold did not retreat from there. It actually accelerated its gains. So let's end with something positive, as we always do, and that would be higher real wages and more affordable rents. As you know, this is my favorite chart to look at to see the health of an economy, to see the health of the average worker, and that's simply comparing wage growth to inflation. And for 28 consecutive months now, we have wages outpacing inflation. Before that, it was a terrible period of time where people's purchasing power was being eroded. You had the highest inflation rates we've seen since the early 1980s. And with that inflation rate coming back down, wage growth continuing, we've now had 28 consecutive positive months. Hopefully that continues. I don't want to see, obviously, inflation get out of hand here, which is why I've been arguing the Fed should hold the line here. So hopefully we'll have many more months of positive real wage growth to come. And in terms of rents here, this is very important, of course, because this is the biggest expense for most households would be on the housing part. And we've seen over 2 years now where our median rents have actually gone down year over year on a national basis. Of course, every city is different, but on a national basis, we've seen declining median rents overall. And because wages have gone up, of course, over the past few years, that means rents have actually become more affordable. So in this chart here, I'm showing you the average hourly earnings and adjusting the rents for those average hourly earnings. And when you do that, we're about the lowest point we've been in the past decade or so. So a big difference than what we had in 2022 during that inflationary spike where rents were very much unaffordable. They've gotten much more affordable over the past few years because rents on a nominal basis are actually below where they were at the peak in 2022, but wages are significantly higher. So this is a great sign. Hopefully this continues, and it seems likely over the next few months, at least throughout the rest of 2025, likely this is going to continue because we have the vacancy rate here at the highest level we've seen on record, data going back to 2019 here. 7.1% is the multifamily vacancy rate in the US. So this is predicting a lot more supply than demand, which means you have a lid on rents. So hopefully we see even more affordable rents. That's great news for anybody in the rental market waiting to buy a home, puts more money in people's pockets. So great trend to see. So hopefully hourly earnings continue to outpace inflation and rents continue to become more affordable. We'll end it right there. Thank you everyone for joining me on the Week in Charts this week. Have a great weekend. If you're watching this on YouTube, hit that subscribe button for all the latest content from us, and I'll see you next time on the Week in Charts.